Kicking off our list for the top 5 best value stocks to buy right now, at number 5 we have Ford. We have a December 2026 price projection. I put their EPS at 1.5. I upped their PE by 3% to 7. That would give us a price of 10.5, which is a 6% upside. The analyst 1 year for Ford is 1071, which is an 11.5% upside. The recent tariffs are going to increase short-term volatility. However, Ford's PE is 6.4 right now, which is very average for Ford, and it does tend to spike from time to time while coming back to that 6.4. So that, I think, makes this a great value stock in that opportunity. And another opportunity for Ford is the price to book. It's at 0.84 right now, which is historically lower than their average, which seems to hover around 1.1. Their dividend is obviously super reliable. It's at 6.5% right now. The risk is low, the reward is low. I'm going to put Ford as a buy. Moving on to number 4, we have FedEx. FedEx, I have a December 2026 price projection. I upped their EPS by 38% to 21.66. Their PE, I dropped 7% to 15. That would give us a price of 324.9, which is a 28% increase. The analyst 1 year is 323.39, which is a 25% upside. Obviously, you have the tariff concerns as well. I think that's going to be a short to medium term volatility risk there. Global shipping packages, however, are expected to go up around 25% still by 2028, so in the next 3 years here. The risk is low, the reward is going to be medium. I put FedEx as a buy. Moving on to number 3, I have ConocoPhillips. I have a December 2026 price projection. I upped their EPS to 878. I upped their PE to 14. That would give us a price of 122.92, which is a 36% upside. The analyst 1 year is 132.15, which is a 45% upside. What we're going to see, it's forecasted that oil is going to steadily grow out to 2029. McKinsey is forecasting a rise in natural gas demand out to 2037. The price to book is 2.25, which is a little higher than average, but their dividend is pretty good right now at 3.4%. The risk I put is medium. The reward is medium. I put COP as a buy. And at number 2, we have Transocean, whose shares are down 98% from their all-time high back in 2008. I have a December 2026 price projection. I put their revenue per share at $432. I upped their price to sales by 37% to 1. That would give us a share price of $432, which is a 42% upside. But here is where it gets really crazy. The analyst 1 year is $490, which is an 83% increase from where it is today. Their revenue is trending up quarter over quarter. Their TTM net income is looking good, but their price to book is looking phenomenal at 0.31. That's really the highlight for RIG and really where the opportunity is here. Oil demand, like I said, is forecasted to continue growing slowly out to 2029 at least. The one thing with Transocean, though, is their management forecasts near-term softness, but a strong 2026 and 2027. So for risk, I put medium just because of those near-term management forecasts, even though medium to long-term, it's supposed to be very strong. The reward is obviously very high. I put Transocean as a buy. At number 1, we have Lockheed Martin. Lockheed Martin, like Ford, is more of a dividend stock traditionally, but its low value compared to competitors like Raytheon makes this a great value stock in my books. Lockheed Martin for December 2026, I upped their EPS by 30% to 29.7. I upped their PE 6% to 22. That would give us a share price of 653.4, which is a 38% upside. Their analyst 1 year projection is 531.75, which is an 18% upside. They have an incredibly solid and stable dividend history. They also have a lower valuation and higher growth estimates than similar sized competitors, again like Raytheon. The risk is low, the reward is medium. I put Lockheed Martin as a strong buy. And if you want to see another stock that I recently rated a strong buy, go check out this video right here.